Okay, are you guys there? Hello, hello. Ready for some training?
Hello everybody, how are you? Does the sound is fine? Do you hear me well? So just before we begin, I must warn you that when you log in the webinar, you must log in with your and indicate your full name. We have the list of all the students, and if you don't recognize you, you will be put out of the webinar. So please log in with your full name. Thank you very much. So now, before we begin the session today, and we will have a lot of points to see, I would just like to answer some email you have posted with very, very interesting question. I have had no time to answer all of them, and so I will just give some comments now for these questions. So a question which is often asked is to have my opinion also on your homeworks. You have to know that I check all the homeworks and how the graders grade your homeworks. And so if a grading is nice, and it doesn't need to have additional comments, so I don't add an additional comments. The graders are experienced trader, so you can have confidence in their grading. So this is the first point. So don't ask always to have my opinion. The opinion of the traders is you may have confidence in their opinion. So also, if you have homework with some negative remark, please, if it is not requested by the grader, don't send again your homework. We have to check a lot of homework, tens and tens, quite 200 homework. So please understand this situation. Only send the homework if it is requested. Okay? Thank you very much. Another question which is often asked is about practice. What we call practice. Until now, and until we give you the okay to trade demo, practice only on past chart. Train yourself, train your eyes, train your brain to recognize the right setups, the ideal setup. This will help you when you will trade live with a demo account, with a simulator, with a tester strategy, and of course when you will trade live with a live account. This will be important. Recognize with the insight of the future the ideal setup, the good setup, the bad setup. Observe what the price is doing after a good setup. Observe what the price is doing after a setup you are not sure for. And in case of doubt, of course, don't trade. Okay? A little practical question about the MACD diamonds. Yes, it's true, sometimes the diamonds is not well displayed. This seems to be indeed related to the 5-digit brokers, MT4. So we cannot modify it if we don't have the source of the indicator. And I have seen that some of you have proposed to change the code. I see McLean, Sean. I thank you very much. That I appreciate. And we will see what we can do for that later. And that last question. Yes, Anthony, you have posted a nice question. How can you profit for the MX with the new NFA and the FIFA rules? That's easy. You see on my chart here, for example, if at a moment anywhere you open a trade, for example, let's say here with 2 units, later you open another trade here with 2 units, and then you must close just 1 unit to take a profit, an MX. So there you will sell 2 units, here you sell 2 units, here you buy 1 unit. And by the rule of the FIFO, which unit will be closed? 1 unit here, and it will remain just 1 open unit here. And the FIFO rule is right. It fits right with the max systems, with the way we close the units whenever we have HEMIX to take, whenever we have to bank a profit. You can make the test, you can make a simulation, you can close the units in whichever you want when you have to make HEMIX. At the end, when you make the XXX, the final exit, you will have always the same result. And so the max method is compliant with the FIFA rules. And because you are not allowed to hedge, when you buy here 1 unit, this unit is closed against one of the 2 units open or bought or sold here. So these new rules of the NFA have really no consequences on the max systems. Okay, I hope this is clear. And you will see that when you will be able to practice in a demo mode. And so I have just checked or seen last homework, clean. So sorry you are late with your homework. There was a delay for yesterday, 9 p.m. I will see if I have time to check it, but please respect the delay. We have a lot of things to do. The graders are also occupied with other activities. They take on their time to help to grade your homework, so please respect their time. So thank you very much. And so now we are going to begin the session today. And what will be the context of this session? Oh, I see a question by Arnold. Can you repeat, Eusebio, about NFA first 2 units? So it's simple. If here you sell 2 units because you have a short trade, when you make an MX here, you will buy just 1 unit to close it. So this bought unit will be closed against one of the 2 units here. Is that clear? Another way to do, you can always open 2 independent units here, and when you have to close here 1 unit, you close one of them. That's so simple. And we'll be able to test this kind of procedure when we will give you the OK to demo trade. Okay? Fine. So what will be the content of the session today? We have a lot of points to see. Let's see on my PowerPoint presentation. So we will make, first of all, some recap about what we have seen yesterday or last session. We will then see an additional indicator or oscillator, the OBOS. We will see then a very important indicator, the non-lag MA. And then we will study an important subject, the stop losses. It is a question which has been already asked several times by some of you. We will see now, because we will have quite all the basic max method seen, and so it will be the nice time to see how to fix the stop loss. And then after that, I will ask you to have a pen and a paper to take note, because we will have some very important matter with Vinny. And after that, after having illustrated all these new tools, I will make some recommendations before giving or assigning you homeworks today. And these homework will be very, very important. So take attention to these homeworks. Well, so for the recap now, last session we have seen a very important concept about the MO. We have gone deeper in the MO, and we have seen 2 specific kinds of MO, the breakthrough MO and the breakout MO. The breakthrough MO is when the price goes from one side of the home base to the other side of the home base without resting too much on the home base or around the home base. And the price must close over the home base. And the 3 EMAs must have angle and separation, so they must be in the right order. But they must not be in the right side of the home base. They have just to be angled and have separation. And that, if all these conditions are filled, if the price is not too far from the home base, then we can enter immediately a trade. If the price is too far from the home base, like the standard and safe MO, we wait for a pullback. Okay? And the danger of the BT MO, the breakthrough MO, is that very often the price retraces back to the home base or very, very near the entry price level of where you open the trade. and for the breakout mode, the BO mode. So when the price crosses the home base, in fact, it stays sometimes around the home base, but also the EMA. And so you have a clear consolidation zone around the home base, right on the home base, or just below, or just above. And in this case, we have to wait for the consolidation breakout. When the price breaks that consolidation zone, then we can enter the trade. We will have the opportunity to see other example on the chart for these two kinds of MO, but don't forget one thing. The MO at the very beginning of a new trend is not either a BTMO or a BOMO. Sometimes you cannot say it is a BTMO or a BOMO. It is a standard MO, and so you have to choose for the safe and perfect MO. Okay? These two MO are special cases of MO for which you have special rules to open the trade. And then, of course, you have the REMO. A REMO is when the price crosses again the MO line in the direction of the trend, but you have previously exited all your remaining opened units. Fine. Then we have seen also how an alternative way to make scalings with the MACD diamonds. I remember also it was one of the questions asked by a student in the last emails, how the diamonds appear in this indicator. So the diamond appear when the MACD turns in the right color. For example, from red to blue, you have a green diamond, or from blue to red, you have then a red diamond. But the diamond appears when the bar closes. And so when the change of the color in the MACD is confirmed. And sometimes during the build of the bar, before the bar closes, if the bar is itself, if it follows a nice pullback or a nice ledge, which is broken, you can enter before the close of the bar. So this is a very aggressive way to scale in, but it is possible so. Then we have seen a very, very important tool in our arsenal of indicators, the Bollinger Bands. We have seen the Bollinger Bands for the exit, when the price makes crabgrass outside the upper band for an uptrend or the lower band for a downtrend. We have seen that the Bollinger Bands are really appropriate to illustrate the consolidation zone, and we will go a little deeper when we will see example of trades on charts. And so we will see also that the Bollinger Bands are very important also for some kind of MO, when to enter a more safely. So, to our arsenal of exit techniques, so we have added some patterns, some specific patterns on the Stowe RSI with the M's and the W's. We have seen also 4 kinds of reversal bars, the doji or the quiet doji, the pin bar, the inside bar, the outside bar. And when in a sideways you have 2, 3 or more of these reversal bars, you know you have a nice place to exit, and even to exit all your units. And if the trends resume after that sideways, which may last several bars, 8, 10, 20 bars, 2 hours eventually, if you have a re-entry point, at that moment you can always re-enter with your trades. So never hesitate to exit when you have a sideways with several of these reversal bars. And of course, in our exit techniques, we have seen the case of the crabgrass on the Bollinger Bands. So now I will just illustrate some case of BT and BO-MO, just to remind you these 2 kinds of MO, because through the homeworks it seems that some of you have some difficulties to understand the difference between these 2 kinds of MO. And let's take the example here of the pound yen. And let's go in the past. And let's try to find some example. Here, let's see these cases. What kind of Mo is this? Is it a BT Mo or a BO Mo? Is it a BT Mo or a BO Mo? Jerry, a BT Mo. Are there other opinions? BTMO. Yes, indeed. This is a BTMO. Why? We see clearly that the price goes from one side of the home base to the other side of the home base. Of course, here it stays some bars around the home base, but it goes through the home base. And more importantly, we see that the three EMAs are angled and separation. They are well far above the home base. This is the typical situation of a breakthrough Mo, and which must be handled as a breakthrough Mo. Where is the setup bar? The setup bar is the first bar which closes over the home base. The first bar which closes the home base with the three EMS feeding the condition is this bar. Here, it is this bar. But we have to check also if this setup is tradable or not. And here we had an important news on the yen, so we know that we cannot trade this kind of setup. We have to wait. And we have seen here the consequences of that news. The price has consolidated sometimes. We have to wait approximately half an hour before considering to enter a trade. And so the proper setup is not this bar, but this one. This one, quite half an hour after the news. This is the first bar which closes below the home base. To have a safer place with the BTMO, you can even wait for a bar closes below the channel of the home base. So your setup bar may also be this one. And depending if you consider that this bar is a long bar or not, if it is not a long bar, you can enter on one of the following bar. If you consider it is a long bar, you know what you have to do. You cannot enter after a long bar. You wait for a pullback. For example, here you will wait for the breakout of this support line of this pullback. Now, let's suppose you have taken this trade. You know that for a BTMO you have to close it very closely because it often retraces to the home base or near the home base. And it was the case here. You had a nice Storesai divergence. You have a higher low here and there a lower low, so a bullish divergence. So you know that around here you had to close the trade and then to re-enter. And as the price progresses, you see that the price is making a consolidation. And so this is a kind of example of a BTMO which becomes a BOMO. And sometimes it will be the case, it will be difficult to decide between a BTMO and a BOMO. The setup can begin by a BTMO, but it has to be handled as a BOMO. And here, to re-enter, in fact, you wait for the consolidation, here the consolidation zone to be broken. So it's easy. You draw your support line. You see here you have swing low. You see also another very important clue, the Bollinger Band, which is horizontal, and you know that around that Bollinger Band, you will have your support line. Another way to illustrate this consolidation zone, you can draw a Duncan channel like the turtle trader, and when the support line here is broken, you have your entry here. And you will see that often, in this case, this is also an important indication, when the support line is broken here, it will correspond also with the Bollinger Bands, the lower band here, being crossed by the price. This is also a very important indication for a Mo. And you see, incidentally, then it is very near the trailing wheels. But it will not always be the case. It will depend of the volatility of the pair. If the pair at that moment has a higher volatility than usual, the Bollinger Band will be farther than the trailing wheels. And in the future, we will no longer use the training wheels, but we will use the Bollinger Bands for our entry point here to see if we have enough momentum is the price. I remind you that the training wheels has the aim to show that the price has gained enough momentum before entering or opening the Mo. And so in the future, but it will be at next session, at the next session, we will use instead the Bollinger Band. Okay? Let's see another example. Here, what kind of Mo is this case, this situation? A BO Mo or a BT Mo? Yes, Anton, it is a BO Mo. Why? We have clearly here the price going from one side to the other side, but not only the price is around the home base, but also the moving average. So you don't have angle and separation of the moving average. In this case, you have to wait for the consolidation zone to be broken. And here you see that when the three moving average are gaining angle and separation here, you will be in fact 5 bar to the left, 1, 2, 3, 4, 5 here. You are too far from the home base to enter directly, and you are also seeing that the Bollinger Bands show that the price are in a consolidation zone. They are narrowing. One of the bands, the lower band here, is quite horizontal. You know you are in the consolidation zone, and you have to draw its resistance line since we are looking for an uptrend. You take one of the swing high. I draw the line here. Take, for example, this swing high. You draw your resistance line, and incidentally, you see that this resistance line go exactly on this high. And so a good entry point will be when the price will cross up this resistance line. If you want to have another safer entry, eventually, if you consider that this consolidation zone is is not enough wide, and you take this swing high, you draw your resistance line, and when the line is broken, you can enter here at that moment. Okay? You can see also incidentally that when you enter here, you are not very far from the first pullback here, which would be an alternate way to enter your Mo. The pullback is right on the Mo line, and so in this case, you are right on the training wheels. Very often, the momentum, the enough momentum for the price will be when the price will go over the mid-distance between the Mo line and the Bollinger Bands. Okay? This corresponds for normal or high volatile pairs to the first Bollinger, to the first standard deviation, in fact. Let's see this example. You have also spaghetti around the home base. So you wait for the price to break the support line since we are looking for a downtrend. And here you have an example. If you enter here immediately after the price breaks the support line, you have a fading trade. But you are in a situation here where you have a long bar, and so, you know, after the long bar, you do not enter. And so this trade has been avoided. Okay? Now, I hope that the different case of BT Mo and BO Mo is much more clear for you now, and you will recognize more easily in the future. And in doubt, if the setup is not clear enough for you, wait for the safe and perfect Mo. Okay?
Eusebio.
Never try to trade. Never try to force a trade.
Hi.
Yes, Chris.
Hi. A question has come up, and it's
Yes.
Why do you use a parallel support line and not one that runs from one tail to the other? In which case,
Sorry, can you repeat the question?
the support line at the bottom, the white
Yes,
one.
this line.
Why is that not angled up, connecting the bottoms of the wicks? Why is it a
Because
parallel?
you see that while the consolidation zone is developing, you know you are going to enter somewhere here when the mole line will be pointing down. You have a swing low here. You have the Bollinger Band which is quite horizontal. So it's normal in this case to have a support line which will be horizontal. If the Bollinger Band would be angled, for example, this way or this way, then in this case, it is not forbidden to draw a support line which is angled also. In general, a good clue is to have the support line or the resistance line for the upside, which is parallel to the Bollinger Band. Okay?
Thank you.
We will see that in another example. Well, to go a little deeper in the concept of practicing, this is a question which has been asked also. The advantage to study path chart, even if it seems to be frustrating for some of you, is to help you to recognize precisely the perfect setup and what the price will do with the insight of the future after a perfect setup, or what it will do after a bad setup. So this is why we ask you to make homeworks in the first time on path chart. Later, after the next session, we will be allowed to use a trade simulator or to make a demo trade to see how you can apply these setups without the insight of the future, but one step at a time. Okay? So now we will introduce a new indicator. And for that I will make some cleaning on my chart. I will simply redraw my template, and we will display an indicator which is called OBOS. OBOS for overbought, oversold. Oops. OBOS. The OBOS has input a length of 13, and we like to choose, for example, yellow color with a double whites. Oops, it's not the right windows. We draw the OBOS oscillator in the same windows as the store RSI, and there is a reason for that. Yellow double whites and 13 as parameter. Okay, now you see the OBOS. The OBOS is an oscillator. It is a smoother version of stochastics. So it has the same properties as the store RSI. So you may say that it is redundant with the store RSI, and it is true, it is redundant. It will give you essentially the same information. Yes, it is 13 for the other. It is the choice. All the parameters which are chosen for each indicator are the parameters which have been tested a long time on every pairs, on every time frames. And so they are the parameters which work the best. Okay? Very often, when the store RSI does not give a sign for an exit, an MX or an XXX with a divergence, for example, so the OBOS may give such a signal. So all the kind of signal you have on the store RSI, you will have them on the OBOS. For example, here, let's see an example here. Here, you have what kind of patterns it is this on the OBOS. It is a W, and after a W, you know what happens. You have had bottoms here. What kind of pattern do we have? For example, here. It's not very clear. I hope you will see. There. a divergence, a bullish divergence, right? If you do not have, it is not the case here, but if you do not have a divergence on the story RSI, but you have it on the OBOS, take this divergence into account to consider an exit, an MX or an XXX, like as for the story RSI. Another very important warning sign the OBOS will give you, the OBOS in combination with the STIR RSI, it is whenever the STIR RSI crosses down for a downtrend, the OBOS clearly, or crosses up the OBOS for an uptrend. Look here, you have a clear crossing here. Let's put a vertical line on the cross, right on the cross. What do you have here? You have a bottom. This is a warning sign that the price will have a chance to continue to go down in the direction of the trend. Look here. You have a cross here. The price is turning downward. Look here. There. The price is down. Look here. There. The price is down a few bars later. So it may be the signal given by the cross of the two oscillator may be just a confirmation because the price has already turned back, or it may be a warning because the price is ready to turn back. Okay? So this is another exit techniques, or not an exit technique. In a downtrend, when you have a cross which is downward, you have a clue, a favorable tumbler to scale in. But when you have a cross in the upward direction like here, oh. Okay, the strategy crosses up the OBOS, you have a sign that you have reached a bottom, or a confirmation you have a bottom. So if you have not made an MX there or an MX here, this reminds you, take into account the possibility to make an exit, a partial exit or a total exit. Okay? So this is a warning sign. Let's see some other example. Here we are clearly in a downtrend. And here you see that the STIR RSI has just crossed for a bar the OBOS. And we are quite right at the top, just at a place to make a scaling. Then later, here, you have a cross upward. You are right here on the bottom. And so here, you may consider to close a unit eventually. Okay? So these are two additional signs with the OBOS for scaling and for confirming a scaling or for considering an exit. And do not forget the sign given by the OBOS, like as for the STIR RSI with the W or with the M, which are here, which are less frequent than with the STIR RSI, but when they present, take them into account. Okay? Well, now that we have seen the OBOS, I will introduce now a new indicator which will give you a better feel of your exit. It is not always clear, even with the STIR RSI or the OBOS, when the exit must be made, or even with some special reversal bar or with long bar. It is not always easy to decide where to exit. And for that, we will introduce another indicator which will give you a better feeling of this kind of exit, and it is the non-lag moving average with these parameters. 0 for the price, this means the close price. The length is 21, we use 21 period for the moving average. We can use alternatively 13, we will see the difference. I like the 13. Many of us like the 13. The displace, it is the shift. It is nice to use 1. The percentage for the filter, you use 0.5. And the rest of the parameters do not change. You use the standard value. And here is the, I hope you see it clearly. Let's move the chart to better see it on the right, for example. Here, we see it clearly. You see that this moving average is drawn in red in a downward movement. It is drawn in green in an upward movement. And so, if you don't know how to exit, the rule is simple with this moving average. Whenever the moving average, here you are in a downtrend, okay? And here you see that the moving average is turning from red to green. If you wait for the moving average to turn to green, it will be too late. It will turn green at the close of the bar here. So it will be too late to exit. When you see that the moving average is flat and the price goes above the moving average, you know that there you will have a good exit point if you have not exited before, because you have perhaps an absence of a clear sign to exit. And in the down movement, you see here during this small retracement, the non-line moving average has not changed color. So this indicates you that this little retracement is not an important one. As long as the moving average has the same color, red here, you can stay in the movement. And so, as soon as it flattens and the price goes over, make your exit. Don't wait for the price to close. Sometimes it is not clear that the moving average flattens, but you will see that it will begin to change color here. Here, for example, it is clear that the moving average is flat. It is flat not on this bar, but it is flat on the previous because there is a shift of 1. So you know that at the end of this bar, the non-lag is flat. So as soon as on the next bar you see that it begins blue, it goes up, so you make an exit and you take a profit. Okay? Let's see here. Let's suppose you have taken this down movement. You see here that the moving average is flat here. If you have not taken an exit here because you have forgotten the W here and the small divergence here with the price, you have forgotten to exit here. Here you have a reminder, you must exit. Okay? Let's see in uptrend. Let's suppose you enter, for example, for a Remo here, for example, and you don't have, suppose you don't have a clue to exit here. Here you have the non-lag who flattens on this bar. You know that on the next one you have to exit. You exit perhaps losing some pips, but you don't exit too late. Okay, so this is an alternative way to exit if you have no clear sign to exit before. And at the next session, we will see exactly where your exit must be, or quite exactly, with really an uncanny accuracy. Let's take a full example of a max trade. Here, let's take this movement. What kind of movement we have here? Do we have a BTMO? Yes, we have a BTMO because here when the blue line, the blue balance line crosses the red line, we know we are shifted by 5 bars, so the cross comes 5 bars to the left, 1, 2, 3, 4, 5. It comes during this bar. So at the close of this bar, here you don't have a proper entry bar. If you take a conservative entry mode, when the price goes over the low of the bar, you don't have an entry bar, but you see you have a pullback. So you can enter on the pullback. You enter here. Here you will have your BTMO. Okay? Then during the trend, you see the non-line moving average is always pointing down. So you must have confidence in this movement, even if you have bottoms here on the story RSI. And whenever you have the red diamond here, you know you can scale in. Oops. You know you can scale in. It is on the next bar here. So you know here you can scale in there. Okay. Then you continue with the down movement. You have another scaling here. Here you have a nice ledge. When the support line of this ledge is broken while the MACD is becoming red, you can enter there. And then here, if you ignore this divergence, if you ignore it, but you should not ignore it, of course, you know that normally you must exit. The divergence is confirmed on the blue bar here, so you have your exit there. But if you ignore that, you know that you see that on this bar, when this bar is closed, your moving average is flat. And so on the next bar, you can exit. And so you will exit as soon as it becomes blue. So in this case, you will exit with by losing some pips, but not too much. And eventually you can exit when the bar just crosses up the non-line moving average. Okay? So here you have your SC1. There you have your SC2. And here, because it is a divergence and you begin to be far from the home base, you have two scaling. Then you know here you can make an XXX. And if the trend resumes downward, you can always re-enter. For example, here you have a nice pullback right on the Mo line with a red diamond appearing at the close of this bar, but you see you have a pullback. And as soon as the MACD turns red, before eventually the red diamond appears, you can make an SC, scaling here. Which will be not a scaling, of course, but because the price went above the Mo line and then crosses down again the Mo line, it will be a remo in this case. A remo because here you have your XXX. Okay? And then here you see that you have several reversal bars. You have a bottom with another divergence on the story RSI and on the Orbos. So you know that here you must exit. You have also another sign. You have an outside bar, you have an inside bar, you have an outside bar, you have three reversal bars. So you know that somewhere you must exit. You have another sign. And if you wait still one more bar here, this red bar, you see that the non-line moving average is flattening. And so as soon as you see this bar being blue and crossing up the non-line moving average, you can exit. And so here you will have another XXX. Okay? And on this movement, which is a small movement, how many pips have we done? Vanessa, are you there to count the pips? Here, if we enter here, we have made an XXX. Let's say here we have made 48 minus 7 minus 6, 42 pips twice. 42 pips twice. On this scaling here, we made 10 minus 6, 4 pips twice. And on this remo, we have made 19 minus 6, 13 twice. 13 twice. No, let's redo the calculation. I am wrong in the calculations. Let's redo the calculations. So here we have the exit is here. So 42 twice. 42 twice plus here 6 twice. Plus, I had forgotten this scaling. Here we are break even, so 0 twice. And here, the Remo, 14 twice. $124 pips for a movement which had only here 55 pips. Okay? A question: what happened to SC2, Dave? SC2 here, I don't understand your question. You have a scaling here. You have a scaling.
Hi, Eusebio.
Yes.
You answered that question by recalculating SC2 in the second run.
Yes.
So that's okay. But there are some other questions up above that, starting at...
okay, that's a good moment to answer this question.
I think so. Starting from... I've lost them all now. Michael Feltham, underneath my name, which says well spotted. And the questions are... it's easier if you read them, I think, if you're able to.
So sorry, what is the question?
Okay, sorry, I was just pointing you to the place in the chat. Michael Feltham has asked, do we consider a new high or low, sorry, it keeps jumping around on me, as a better scale-in setup?
No, not... yes, a new high here in a downtrend, a new high here. So the scaling after a pullback is always better than a scaling in a continuation scaling here, because we have a pullback, and so we always enter higher. We profit of this retracement to enter higher, and the contrary for an uptrend. So yes, the scaling after a new high is better indeed.
Okay. Josephine has asked, why don't we have to wait for the price to close below the 21 before re-entry?
Below the 21? Yes, because it is a Remo. Don't forget that whenever the price goes in a downtrend above the Mo line and it crosses down again the Mo line, we have a Mo. It is always a Mo. And this, in this case, the Mo also coincides with the scaling. It is just a coincidence because we have the coincidence of the scaling and the Remo. And it is a Remo because we have previously made an XXX. We have closed all our units here. So the next time we have a Mo, it is a Remo. Okay?
Okay, thank you.
Whenever the price crosses the Mo line in the direction of the trend, it is always a Mo. Now, this Mo is tradable or it is not tradable. Example here. Here you have a Mo, because this bar crosses and closes below the Mo line, but because it is a long bar, it is not really tradable. Okay?
Okay.
Okay, let's continue. This non-line moving average is important for giving a better feeling of the exit, but it will be also very, very important in another situation we'll see, not at the next session, but the next one, at the 5th session, when we will see the Primo. I don't explain now what is a Primo. You will discover that. So now we are going to see a very, very important subject. And let's keep this chart to illustrate this concept. It is the concept of the stop loss. Where do we put our stop loss in our trades? The first rule, it will be a rule of the thumb, which will indicate the kind of stop loss you can have depending on the volatility of the pair. And the stop loss we will put on our chart will be always an emergency stop loss, a catastrophic stop loss. We have to give to the price enough place to breathe. So we will use large or relative large stop loss, but very often if the trade is invalidated, we will not wait for the stop loss to be hit. We can exit the trade before. And how do we place the stop loss? So a first indication of a good stop loss will be for the 5-minute time frame, will be a stop loss of around 30 pips for low volatile pair. It will be around 35 to 45 pips for normal pair, for example, Euro USD, USD Swiss, USD Yen, USD CAD. And it will be around 50 to 75 pips for volatile pair like the Pound Yen, the Euro Yen, for example. Let's see here, for example, we have our MO here, our BTMO. Where will be the stop loss if we consider approximately 50 pips? It will be around here. And do you see something here? Something very specific. A traditional way to put a stop loss is to consider the stop loss just above the previous swing high-low. Here, as we are in a downtrend, we consider the previous swing high. Okay? The swing high is here. So we put the stop loss just a few pips above this swing high. And we are quite at 50 pips. You see, we are at 38, 39, 40 pips. Another clue for the stop loss is to see around the 50 pips here if we are near the Bollinger Bands. And you see here the Bollinger Bands is at 50, 51 pips. So you know that in this region you have a nice place to put your stop loss. And moreover, as we take a trade here for a BTMO, which is very near the home base, we are well above the home base and well above the 3 moving average. This is also very, very important. Okay? Now, during all the down movement here, you can, whenever you make a scale-in, here, or a REMO, here, you can adapt your stop loss in some very specific place. And in general, the best place to put your stop loss will be along the blue balance line, along this line, which will be very, very regular, quite a right line, if the trend is clear. Okay? And so, when you make your scaling here, you can adjust your stop loss here. You see? And you have reduced importantly the risk on your BTMO. Okay? This is important also. You will see it is important if, for example, here, after this long bar, you make an MX, you bank some profits. So with the profit which is banked here, this profit will completely balance the risk remaining on the second open unit for the BTMO here. So this trade is a free trade, and the only risk you have now will be the risk on this scaling. And you can see how many pips. You will have approximately 50 pips also. Okay? Okay? If you make the scaling, another alternative way is to put your BTMO here at break-even, and it will be often around the MO line. But I advise you to keep a larger stop loss on the blue line, because the blue line will have an important role in the future, later in the trend. So on the second scaling here, you can reduce your stop loss, on the blue line here, and so you have reduced the risk on the second scaling, but you have also a potential profit which is growing, and this potential profit will quite completely balance the risk you have on all the open units. When you make your execution, of course, you have banked all your profit, and you make a remo here, and again, also here, you put your stop loss on the blue line. And you see also this phenomenon, it is right near or right on the Bollinger Band. And it is not far from the previous swing high. So eventually, if you prefer, if you feel more comfortable, you can put your stop loss just above the previous swing high here. Okay? Now, so let's suppose you have your stop loss. I cannot catch the line. Okay, let's suppose you have put your stop loss here on the blue line. So you have banked all these units. You have made your remo here. Let's suppose you forget to make your exit here. You have forgotten for any reason. The price reverses back. Eventually you have made some additional scaling, or it is not the case here because you have a long bar. So, but suppose eventually you see at the moment that the price goes more and more often above the Mo line. Okay, here, and eventually it comes to touch the blue line. So if you adapt regularly your stop loss on the blue line, at a certain time here you will be stopped out. And by adapting the stop loss on the blue line here, if you have forgotten to exit here, you make a loss on your last remo, but it will be a limited loss. Here, for example, you will have a loss of 9 pips, twice. So you lose 18 pips. And this blue line is very important because if the price goes above the blue line, so this means you can always put your stop loss a few pips above. If the price goes above the blue line, this is a sign that the down trend here, the down movement, has dramatically weakened. And if it goes to the red line, you have the certainty here that the down movement is invalidated. It is the end of the movement. So don't wait this situation to be stopped out. The best place is to put the stop loss along the blue line. Okay? Let's take another example here, a long example. We have here a BTMO, but it's not a good setup because the blue line crosses the red line here too far. So we have to wait for the safe entry Mo here, safe and perfect Mo here. You will place your stop loss around 50 pips below. It will be somewhere here. And you see it is just below all the context of the 3 EMAs and the home base. Then eventually you make an MX here. Then you make here a scaling. When you make your scaling here, you can tighten your stop loss on the blue line, and you see you reduce dramatically the risk on your remaining open unit here, which is completely balanced by the profit you have banked here. So this trade has no risk. The only risk you have is on this scaling, and the risk will be 57 pips, 56 pips. So you see around 50 pips. And as long as the trend continues, you will adapt regularly your stop loss on your blue line. Then you will have here another scaling. Oops. Another scaling. Okay. There. Your stop loss will be here. And then you will have probably your exit here because, yes, indeed, you have a divergence on the story side. Oops, here. Okay, here you have the your final exit. And so, at any moment, your trade has been in danger. And if you forget to place, to exit, as long as you adapt your stop loss on the blue line, eventually you will be stopped out and you will lose In general, you will make a loss on your last scaling. Eventually, if you have a long pullback like here on your second scaling, but with a very small loss. And the total loss you will make here will be well balanced by the profit you will bank here the first time. And it is the reason why it is very important to make a first MX here as the conditions happens after 20, 30, 40 pips, depending of the pair, or when you have a sign. We have seen several signs, long bars, several reversal bar, tops, a divergence, and so on. When we will see more in detail the money management, you will see the impact of this stop loss, of how we handle this stop loss on the risk we are taking, we are assuming, as long as the trend is developing. Okay? Question on that important point? Domenico, yes, scaling have stop loss. Here, when you make your stop loss, here was your initial stop loss, for example, when you make the first move, somewhere here, at around 50 pips, okay? When you make the scaling here, you adjust the stop loss on the blue line, or just a few pips under the blue line. You make the second scaling, you adjust the stop loss on the blue line, or a few pips under the blue line. Eventually, between two scaling, you can always progressively adapt your stop loss along the blue line. Okay? Wouldn't the first entry have to be on a horizontal line from that high previously? Where here? No, you have here a BTMO, but when the 3 EMA have angle and segment, you are too far, so you wait for a pullback. You would wait for the break of a resistance line if it would be a BOMO, a breakout mo. Now, yet another big important question. The risk, the financial risk, 1% or 2% of the account is 1 point. The stop loss is another point. The two are independent. But when you have fixed the risk on your account and the stop loss, you can determine the trade size for your trade. We will see that in detail in the money management. So, is the way we use the stop loss is clear? Now, I have said that we should never wait for the emergency stop loss to be hit. It is there to protect our capital if we are not able to act when the movement is invalidated. And here it is easy to see when the movement is invalidated. First of all, most often, if not always, you will have a clear sign to make an XXX, divergence, for example, or at least to reduce your risk. But we will see also at the 5th session, so in 2 sessions, how to use, how to trade the reversal, the counter trend, and when a situation for a counter trend happens, this means that the movement in the direction of the trend is invalidated. And if you don't have a situation for a counter trend, but you see here, when the price crosses down the Mo line, and goes near the blue line, somewhere here you can decide to close your trade because you know the movement, the up movement is finished. For example, personally, I never wait for the price to go too far from the Mo line. I never wait for the stop loss to be hit, and so I reduce my loss if it is necessary. Okay. Well, now I see we will be a little late today. We will see a very, very important secret of the max systems. And this is here, it will be necessary for you to have a pen and a paper, because probably this will be not recorded. I'm sorry. And here, the last indicator for today. It is the Vinini. And the parameters are the following. 55 for the period, 3 for the MA period, the moving average period, 0, 55, 1, and the number of bars to be drawn, 1,440. And it is the William percent range moving average defined by a trader called Vini. You perhaps know this indicator is available on some other forums, so it's not a custom, a proprietary indicator. With the large parameter of this indicator will give you an idea when a movement, like a trend here, a max trend, will end, when it will begin and when it will end. And the rule is the following. You see the indicator is formed by a green line, it is the indicator, and a yellow line, it is its moving average. And this yellow line is the true trend of the price. And you have two horizontal limits, minus 60 and plus 60, okay? And you have the zero line here. So in a downtrend, ideally, you must have the yellow line, the moving average, under the zero line. But most importantly, you must have the green line under the moving average. So here, when the moving average crosses down the Mo line, you have a nice point for the beginning or the resume of the downtrend. And when the green line crosses up the yellow line here, you have a nice place there or there. Here, you have a nice place, and ideally above, but not always above the zero line, you have a nice place to tell the down movement is over. Okay? And as long as the green line stays above here, below the moving average, the yellow line, you may be sure that the trend is strong. Sometimes it will give you also, you see here, this kind of pattern, the W, or for uptrend, the M. This is a sign you have to follow to tell you we are in the bottom of the price and it is a good place to take a profit. It will be very often coincident with a sign in the Story RSI or the OBOS. Also, another very important situation, sometimes you will have divergence also, like here. You have a higher low here. This low is higher than this one. And in the price, this low is lower than this price. So you have a divergence. And so this also indicates that this bottom is a nice place to exit, to make an MX or to make an XX. If you have a conjunction of other indication that it is an XX, for example, here you have also a divergence with the Story RSI. We are far from the beginning of the movement. An XXX is better. So, and whenever also, you see also blue line here. These are Bollinger Bands around the Vinini. Whenever below minus 60 or above 60, whenever the green line goes outside its Bollinger Bands, like here, like here, like here, you have also a clue for a bottom in the price. And so a place to consider to take a profit. For example, here, it is the case here. So you can consider here to take a profit. Here we have seen there. And here, it is the case here. There are places where you can consider to take place. And this is practical if you have no other sign in the Story RSI, in the OBOS, or if you have no sign with crabgrass, if you have no sign with long bars, if you have no sign with reversal bar, and you have this sign on the Vinini, it is a good sign to exit. So you have another exit technique here. Vinini. And I will first of all make some cleaning, and I will zoom in the chart. And I will explain you now a very important concept. Let's take a full example. Here, what do you see around the home base line? You see that the price bounces off the home base, it goes up, it retraces, it goes up, and it comes back to the home base, and then it goes on the other side of the home base. This movement from the home base here to the home base here is called a primary wave. These waves have nothing to do with the Elliott waves. It is a primary wave made of a movement in the direction of the trend, an up wave, and a corrective movement, a retrace movement, a downtrend, a counter trend. So this is a primary wave. Now, this wave, this primary wave, can be decomposed with secondary wave. And the secondary wave are delimited by the red line. You see the price bouncing off the red line and coming back to the red line here. Then it bounces off outside above the red line and it's come back to the red line. So you have here 1, 2, and these little waves are not tradable. So you have 2 secondary waves. And around each secondary wave, you look for the price around the Mo line. You see the price bouncing off the Mo line and then coming back to the Mo line. You have a tertiary wave. Then the price bounces off the Mo line and comes back to the Mo line. It's another tertiary wave, and so on. So, along a primary wave, in general, you will have between 2 and 3 secondary waves. And a secondary wave will be, in general, composed of 2 to 3, in average, tertiary wave. What we are interested is to trade the tertiary wave. And so we try to exploit the movement in the direction of the trade of the secondary wave. You see here, we have the secondary wave.
Hello, you say
you have the uptrend and the counter trend. Okay? Yes, Chris.
Hi. I was wondering if the GoToWebinar has got the ability to use a pencil to mark the chart. If the pencil's not a black one, maybe
that's
that will
right.
help.
That's right. That's right. I think this is this. Let's see. So here you have the price bouncing off the home base and coming back to the home base here. Okay? So you have a primary wave. So it doesn't stay on the screen. I don't know why. Okay. And so what we are interested in trading with the max is the series of tertiary wave along the Mo line until the end of the secondary wave. You see? So all these movement, all this up movement, and this up movement will be handled by the max by entering with a Mo, a BOMO, a BTMO, or a safe Mo on a pullback, for example, and then with each scaling. I will not draw here all the scaling, but anyway. And you will see that when the price ends here, the first tertiary wave, very often you have the sign in the Vinini here, because the green line crosses down here its moving average. And this is much more important when this kind of behavior of the Vinini happens in an extreme. You see the yellow line is above the 60 level. You have an extreme. You have a very high probability that this secondary movement is at its top, and you will have the reverse of this movement. And often the end of the secondary wave here will be indicated by the fact that the yellow line or the green line of the Vinini goes under the 0 level or the 50 level. It is the 0 level here. You see? So it is important, very important, when you begin your trading session to see where you are in the waves. You know that in average there will be 3 or more, in average 3 tertiary waves around the Mo line, 3 secondary waves along the red line. So when in a secondary wave you are past the 3rd tertiary wave, you must be much more prudent, because you are over the average. And when you are over the average, you know that the movement may weaken. So after your 3rd wave around the Mo line, be prudent. If you are on the 3rd secondary wave, be prudent. So you must be faster to close your trades. If you are in the 1st tertiary wave of the 1st secondary wave, you can take your trade without and stay in the movement without a problem. On the 3rd wave of any kind, you must be more prudent. Okay? Let's see another example. Here, you have the price crossing the Mo line, the home base line. You have a nice primary trend or movement wave until here, a long primary wave. You have 1, 2, 3, 4 secondary wave, and in the first primary wave, which is not a tradable wave, you have 1 tertiary wave. In the second secondary wave, you have 1, 2, 3, 4, 5, 6, and the other are questionable tertiary wave. In the next secondary wave, you have only one tertiary wave. In the next secondary wave here, you have 1, 2, 3 tertiary wave. And in each of these secondary waves, so you will exploit this movement, this series of, just a moment, this series of tertiary wave with the max system, with the max rules. Yes, Chris.
I'm sorry, but when you move the chart, it doesn't get displayed out here, and so all we're seeing is static shots. There's a lot of chart to send out to everybody. So
you don't see the chart moving?
No.
No, we're not seeing your cursor on the chart either. In fact, somebody mentioned, Eusebio, if you can draw boxes or you can draw eclipses at these places using the MT4, that might be useful. But we're really not seeing anything on the chart at all.
Why? Because the chart is too small, or because it doesn't move?
Nothing that you're pointing to is showing up. For some reason your cursor is not moving. It's not keeping up with what you're saying. And so there's no correlation between what you're saying and what we're seeing on the chart. So if you could just draw either the boxes, the shaded boxes, or these shaded eclipses at those places and go over that. I think basically based on what Chatsy says, nobody has seen any of this.
Oh, okay.
I'm sorry, but it's just we just haven't seen it.
Now you see this?
Yes.
With the red box?
Yes.
Yes. So this red box is delimiting a secondary wave when the price goes off the red line and comes back to the red line. And so bounce off the red line and comes back to the red line. So we have two secondary waves. The first one, by the rules of the max, is not tradable, but the second one, yes. And along this secondary wave, we will trade all the tertiary wave around the Mo line with the rules of the max. Okay? And I have explained that along a primary wave, which is delimited by the price bouncing off the home base, and when the price comes to the home base to go to the other side, we have an average of 2 to 3 secondary waves, and each secondary wave is composed itself of 2 to 3 tertiary waves. So when we are trading a tertiary wave, the third tertiary wave, we must be more prudent when we open a trade. We can open the trade with the max rules, but we must be fast to close them. And more specifically, if we are in the third tertiary wave of the third secondary wave, we must still be more prudent. Okay? And to see the delimitation of the secondary wave, you have the Vinini here, which helps you when the waves begin. Here, let's put a vertical line. You have the green line crossing down the yellow line of the Vinini and going below the zero line. And when the secondary wave ends here, somewhere here when the price comes to the red line, you have the green line crossing up the yellow line of the Vinini and ideally the zero line of the Vinini. And so as long as the green line stay below here, zero, and below the yellow line, you can confidently stay in the movement. Okay? And this is an important point when you prepare your trades at the beginning of your trading session. Always analyze where you are in the waves. Farther you are in the waves, more prudent you must be. If you are just at the beginning of the first waves of any kind, you have a higher probability for your trade, for your Mo, and for your scalings to be successful trades. Okay? That's a very, very important concept. Well, have I said all I had to say about this? Yes. Now, let's check. What will be your homeworks for the next session? And the next session is Thursday at 5 p.m. East. And it will be nice if you make your homeworks before Friday 6 p.m. East. Friday 6 p.m. East, last limit for the homeworks. I will send you immediately after the end of this session the new indicators, so the OBOS, the VIN-INI, and the non-lag moving average, and the new templates, of course. And for the new students, you will have to make 2 homeworks in only one email, a short chart and a long chart, and you will have to note everything: the Mo, BOMO, BTMO, or SafeMo, the scalings, the REMO, all the patterns in the Stochastic or the OBOS, the M's, the W, the divergence, which are of course indicating situations on which we must act, of course. The situation, the extreme situations on the VIN-INI here, when the VIN-INI indicates you to take eventually an action to close or to open a trade. So you must indicate all, and do not forget the vertical line for the scalings, so that we can see what you do in your trade, and your exit by a small horizontal white line and your entry by a small slanted white line. Okay, and so you must mark your chart completely. This is the first homework you have to do. There is a second homework you have to do, and this is a scrolling exercise. you will take the 2 last months, June, July, for example, or from mid-June to mid-August, to cover just 2 months. You take a pair, any pair you want, on the 5-minute time frames. And on this pair, on the 2 months, you must count all the mo at the beginning of each trade and all the remo. So this means when you have identified a correct mo, a BT mo or a BO mo or a safe mo, a safe and perfect mo, you must also identify where your XXX would be in order to see where will be your next remo. And you have to just to count the mo, BO mo, BT mo, safe mo, remo. And you will indicate how many or what percentage of these mo will give winning trades, and how many mo will be losing trades. I have an idea of how many mo you must have on the 2 months on any pair. I have an idea of the percentage of winning trades or losing trades. Every max trader, experienced max trader, have these numbers. So by doing this exercise, you will see the power of the max. And this will be an important way to have confidence in the max. So 2 months. Okay? Is it clear? Guessing. What do you mean, Anton, by guessing? Yes, you will have the hindsight of the past. Right. This means that you must be able to mark the right mo, the correct mo. Okay? No, you cannot guessing the number. You must you must go through the 2 months to have exactly where the mo is located and to count them. Okay?
Eusebio, can I interrupt you again, please?
Yes.
Okay. Just looking back, there is still quite a bit of confusion about these waves, and I know we're quite a bit over time. Could you just perhaps quickly review this wave explanation one more time, briefly,
yes,
so that some of these folks who are confused,
yes,
and have asked about it would understand? Thank you very much. Thank you.
To better see the waves, I will take off some indicators. We will see better what happens on the chart. Let's take off the non-lag. Let's take off the Bollinger Band. Okay, and just let's keep the, let's take off also the blue balance line. Okay, just keep the home base, the red balance line, and the mo line. Okay, so when the price crosses the home base, coming from one side to the other side, like here, it goes from the high to the low of the home base, the price bounces off the home base and then comes back to the home base to go to the other side. So here it's not the case. But later on the chart, if you see my chart moving, it is the case here. The trend, the downtrend ends, and it is the beginning of a new uptrend. You have a primary wave, okay, from the entry point of the on the home base to the exit point here on the home base, a primary wave. This wave itself is decomposed of, or is composed of, secondary wave, and the secondary waves are delimited by the red balance line. When the price bounces off the red balance line, the secondary waves begins, and the secondary waves ends when the price goes back to the red line. So here you have a secondary wave. Here the price bounces off again from the red line, it goes down, and it goes back to the red line here. You have here so a secondary wave. And again, here, the price bounces off the red line, goes down, and then revert back to the red line. You have a third secondary wave. Okay? Now, each secondary wave is itself decomposed of tertiary wave, we will trade with the max. And the delimitation of the tertiary waves is given by the Mo line. Whenever the price bounces off the Mo line and comes back to the Mo line, you have a tertiary wave. For example, here, the price bounces off the Mo line, goes downward, and then revert back to the Mo line. That it bounces off, it reverts back to the Mo line. You have a second tertiary wave, and then a third, and then a fourth, and then a fifth, and so on. Okay? And what we trade with the max, with the rules of the max, we trade the tertiary wave. Okay? The secondary wave are delimited by the behavior of the Vinini. This is why you can stay confidently here in a downtrend as long as the Vinini doesn't indicate you clearly that the secondary wave has ended. Okay? Is it more clear now?
That's much more clear. I think everybody sees the explanation of the waves. So if you can just maybe tie the wave action a little bit more closely to what the Vinini indicator is telling us, then I think we will be able to put the waves and the Vinini together and understand how they relate. So far, so good. Thank you.
Yeah. Okay. So the Vinini is related to the secondary wave, so to the wave around the red balance line. So I have explained to you previously that a downtrend is indicated mainly by the Vinini when the green line of the Vinini goes below the yellow line, and ideally, but not always, if both are below the zero line. Here you have the zero line, and both are below the zero line. Okay? And here you see with this vertical line that it is precisely this situation which indicates the beginning of the secondary wave. And here, when the green line goes above the yellow line being pointing up, and the green line crossing also the zero line, ideally but not always, both must be below the zero line, you have the end of the secondary wave. Okay? Like here, on this vertical line. It would be ideal if you had also the yellow line above the zero line. But this is not always the case. And so as long as the green line of the Vinini stay below the zero line and below the yellow line, you can stay confidently in the trades, in the movement. Okay?
Eusebio, thank you very much. Based on the Chatsy comments, I think everybody has it now. Thank you again.
Yes, the deadline, Anton, is Friday, 6 p.m. East time. Now, just to finish the session here, I would like to show you a last PowerPoint page. This one. It will be some recommendations, some do's and don'ts. In the column of the do's, this will be very important. Only open a trade on a clear setup. If the setup is not clear, don't open the trade. Okay? If you are not sure of a setup, don't open the trade. You can eventually scale in on a reversal bar. When a scale-in is indicated by the MACD, if the bar indicated by the MACD, the setup bar, is following a reversal bar, you can enter more confidently in the scale-in. In any situation, in doubt, if you have open trades, close them. Close the trade immediately if you identify that the trend is invalidated. Okay? As we have seen, use a large emergency stop and tighten the stop loss with each scale-in. Of course, never forget to take your profit in adequate situation. And this is the most important recommendation. Always, always have confidence in your moving average and their angle and separation. If you should keep only one thing in the max, it would be this recommendation. And in the column of the don'ts, never open a trade in a spaghetti zone, never open a trade on long bars, never open a trade when you have a majority of tumblers defavorable, never open a trade in doubt, never open a trade against the non-line moving average, and don't let the emergency stop loss be it. And another very, very important consideration, never be greedy in your trade. We will see that it is much more important to manage the risk and the loss than to manage the profit. Okay? We are now over with the PowerPoint, and we can perhaps take just a few minutes for some questions if you have some questions.
Hello, Eusebio.
Yes.
Hi. While people are typing up any questions, I've just got a little bit of housekeeping to go through. First thing is, for the students, read other people's homeworks and the comments that are made by the teachers. They're really, really important. Eusebio's comments and Vanessa's and Aries are really crucial for you to understand and learn how things go. That's number one. Second thing is, we'd like you to put a little piece of information about yourself, like how long you've been trading, where you come from, that sort of stuff, in your bio on the Google page. I'll send out another page for it, but a lot of people still haven't told us who they are, and we'd like that, please. Gives us an idea on what the class is like. Some people have been surprised that Eusebio is not marking all the homework. At the moment we're up to over 700 emails in the Google group, so I'm not expecting him to do that. Some of the graduates from previous courses are coming in to help out, which is really great. It does two things. One, it takes a huge workload off Eusebio, and for that we're really grateful. And the second thing is it also increases their knowledge and capability quite a bit. So thank you to those guys, and Eusebio checks all the homeworks anyway. It just means he doesn't have to write on all of them. And the final thing, just repeating what Eusebio said, please don't send in more than one set of homework unless you're requested to. Thank you. I'm done with my little rant.
Yes, if there are errors pinpointed in your homeworks, try to understand why it is an error. In general, the comments will describe the errors. Check the portion of the video related to that point in your homework. Check also the homework of the other. There will be quite a certainty that you will see a homework identical to yours, because we have a limited number of pairs for our homework among the pair I have indicated to you. So this must be the first step you must check to understand why you have made an error. Of course, if you are not sure, you can always post a question in the Google groups. And if you have a question, don't forget, please, to add a chart to indicate your question. It is not always for us, the graders, to remember the homeworks of everybody. So if you have a complimentary information, please join a chart. Okay?
Sorry, one more thing I forgot is that the previous students, the grads, have their own area in the forum. So if you haven't signed into the forum yet, please do so. I'll send it out in the email as well. Just sign on, activate, and you'll be allowed into the homework room there, where there are questions and comments as well. You'll be able to see how previous students are doing stuff. Learn from other people's charts. That's the way to go here. Thanks. I'm done.
Okay, if there are perhaps a few questions. I have not followed all the questions in the chat. If Jerry or Chris or Craig can pinpoint the question.
One question that's come up several times here is what is an invalid Mo? How would you define an invalid, or perhaps illustrate an invalid Mo?
Okay. An invalid Mo. So let's clean and make a zoom in here. Let's try to find one. It's not easy to find directly an invalid, and let's take the template. Okay. Well, let's see here. Again, you can have, it will not be easy to find a failing mo here. It will not be easy, but what you can have is the following situation. Let's suppose, here, you have had probably a news here, so a long red bar. On a long red bar, you know you cannot enter, even if you are in a situation of BTMO. You wait for a pullback, and you have a nice pullback here on the Mo line with a very nice retracement. And you have here a setup bar for a Mo, for a remo. And so here, if you enter conservatively, if you decide to enter when the price goes below the low of this setup bar, let's make another zoom, we will see better. So here we have the setup bar. If you try to enter below the low of the setup bar, you never enter. So you don't have a trade here. If you enter more aggressively on the open of the next bar here, or when the price goes below the close of the setup bar, you enter here. So you have opened a trade here. And this is an example of a Mo which has failed. So where will be your stop loss in this case? It will be perhaps 50 pips around, above your entry point, and certainly above all the complex here of the home base line and the moving average, so somewhere here. And if you wait for the stop loss to be hit, it is hit. So here is an example of a invalidated Mo. Now, when you see the price crossing the home base, you know that the crossing of the home base is always a critical point, and it may be always the starting of a new trend. So what I do personally, in this case, if I have taken this trade, when the price goes against me and crosses back the home base, I close here, and I don't wait for the stop loss to be hit. Okay, this is just an example of an invalidated Mo. But if you do correctly the second homework I have asked you to count on a period of 2 months, the different Mo, BO, BT, Safe Mo, and Remo, you will be surprised of the success rate of the Mo. Okay?
Hi, Eusebio. I think we'd better wrap it up. It's gone way over time.
Okay. So I wish you a very good homework, and post them so before Friday. If you have questions, put them in the Google group. And so, good trade and good work. So, bye bye, and see you Saturday at 5 p.m. East.